Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a network for family offices based in Greenwich, Connecticut. Our next summit will be on November 20th in New York. Please sign up for the Circulus newsletter to stay in the loop at circulus.substack.com. Today we are traveling through one of the great family business stories, that of Goya Foods, the formation of their family office, and the creation of a freestanding private equity firm that focuses on family businesses called AUA Partners. Andy Unanue is the founder and managing partner of AUA, an operationally focused lower middle market investment firm with expertise in supporting growing family-owned and demographic-driven businesses. AUA's business model is driven by Andy's own family background. He's the member of the Unanue family, which owns and runs Goya Foods, the largest producer of Spanish and Latin American foods in the United States. Andy's grandfather, Prudencio, founded the company in 1936, and Andy's father, Joe, was a legendary CEO of the firm himself. Andy was a leader of Goya for many years, ultimately serving as its chief operating officer. Andy received his MBA from the Thunderbird School of Global Management and his BBA from the University of Miami. Please enjoy my conversation with Andy Unanue.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
Can you tell us about your grandfather and how the Goya business got started?
Yeah, so my grandfather, Prudencio, and my grandmother, Carolina Unanue. My grandfather emigrated from Spain, came to New York, got his degree in bookkeeping, started working for some food companies, decided that he wanted to be in the food business, was a food broker, was brokering Spanish foods coming into the United States. Along that process, he was selling food. As it came to the United States, sometimes it was a different brand because of issues in Spain's economy, whether it be the Depression and Franco and all that, but eventually decided that he wanted to create his own brand because he'd order 50 cases of X brand sardines, and by the time he sent the order to Spain, they fulfilled it and they came back, he got a different brand. We would talk to the counterparty on their side and said, look, the company you ordered was out of business, so I could either short you 50 cases or fill it with a different brand. I decided to fill with a different brand. So through that process, he decided he wanted to create his own brand and form a company around that brand. As he was going through that process, he got a shipment of sardines that were actually branded Goya, not what he ordered. So he talked to his counterparty and said, I really like this brand. I want to talk about being the exclusive distributor. I said, the brand is out of business. What you should do is really go down to the U.S. trademark office and trademark the brand, and we can start packing everything under the Goya brand. And that's what he did. Paid the guy $1 or something for his advice and for his candor, and started changing. Instead of ordering different brands, started designing his own labels and putting everything under the Goya brand. And that was the beginning. And started Unanue and Sons in 1936, grew that, eventually started doing everything under Goya. Then the second generation came in after World War II, and the business started growing a little bit more and a little bit more. But it was really my grandfather's vision to bring foods from his native land of Spain into the United States.
How did he initially grow the business? There was lots of food importers at the time, but he obviously did something special.
He just found the niche for high quality food and being consistent. And then he was smart enough to understand that the demographics of the United States was changing. And then when Operation Bootstrap happened and all the Puerto Ricans started emigrating up north, he started evolving his product base. So not just foods from Spain, but he saw the common link with the language of the Puerto Rican community. He had been commuting back and forth to Puerto Rico because he enjoyed Puerto Rico, and my grandmother and him spent some time in Puerto Rico. So started evolving and growing the product line, and he really had the foresight to understand that if he wanted to sell to the Puerto Rican community, he should hire Puerto Ricans. So started bringing in Puerto Rican workforce, understanding the products and the channels and where to sell through that institutional knowledge, and started growing the brand that way. And then as all the different Latino cultures started emigrating into the country, started targeting all those through Spanish language media, radio, and building the brand over the evolution of the Hispanic population coming into the United States.
Was it always assumed that you would join the business?
I don't know if it was assumed. I always wanted to. Look, like a lot of kids like me in my position, I worked every summer since I was in 7th grade. And I enjoyed it. I enjoyed the people there. Everybody was nice. So I think it was something I had always wanted to do. My brother had joined the business. One or two of my sisters had in and out. My cousins, of course, did. But I don't think it was ever pushed on any of us, and everybody had their own choice, but something I wanted to do and something I enjoyed and something I'm glad I did. Helped me get to where I am, learned a lot. But yeah, there was no pressure to join or anything like that. We're not joining. It was just left up to, well, there's 18 in my generation, kind of left up to the 18 of us as to who wanted to join and all that.
What was the firm like when you joined it?
When I joined full-time out of college, I moved down to Puerto Rico, and that's where our largest manufacturing base is, and worked for my uncle and my brother down there. It was great. It was a big manufacturing facility. Goya is extremely vertically integrated, so we do everything from buy 20,000 pounds of rolls of steel. We cut the steel, coat the steel, decorate the steel, form the cans, fill the cans, do the same thing in plastics for blow molding for containers for sauces and spices. And then we distribute to our distribution centers, and we still run a DSD, direct store delivery system, to retailers. It was a great business. It is a great business. It was very closely knit. My uncle and brother ran a family business in Puerto Rico, and that's where I started my career, my full-time career. So it was a lot of fun. And Goya had extremely strong brand presence down in Puerto Rico. To this day, there's still surveys for the strongest brand in Puerto Rico, and Goya usually wins as the most respected and revered brand on the island, and it usually beats out either Nike or Coke. So all out brand, unassisted recognition. It is the strongest brand in Puerto Rico, even to this day. So it was fun. It was good to work with my brother, great to work with my uncle, and it was a lot of fun. And like I said, I met a lot of great people down there, came very close. A lot of these people knew my cousins since they were babies because they grew up in Puerto Rico. So it was truly a family business in Puerto Rico. And then I eventually moved up to the United States to headquarters in New Jersey 3 years later. And same kind of concept. I'd known most of the employees there my whole life because I had started working there in 7th grade. But it was a wonderful experience.
What were the business challenges that you faced when you became COO?
So I think what I wanted to do was to evolve the business, continue to have family be part of management and to run the business and maintain ownership, but to evolve a very well-run business. And what I wanted to do was bring it from a very good business to best-in-class business, and to bring in some outside management, professionalize some management positions, and then also bring in a outside board of directors commingled with the family so that we could prepare Goya to be a best-in-class business in the consumer packaged goods space and set it up for a perpetual family hold. And that's what the goal was. Some of the challenges were getting that done, professionalizing, commingling family management with outside management, breaking through into different channels of distribution, the Walmarts of the world. So the evolution of the supermarket and food retailing industry in the United States is all the powerful Northeast brands, or most of the powerful Northeast brands, aren't the survivors. There was no Walmart in the Northeast. There was no Kroger. There was no H-E-B. There was no Safeway. It was Pathmark, Brand Union, and those brands are gone. Developing and evolving Goya into a national brand through different channels and getting into different retailers, opening up to Walmart and how they go to market, which is a little different than us. We're still a direct store delivery system. So managing all that and the dynamics around the family were really the challenges I faced.
So it was a head-to-head competition with Walmart, or were you trying to integrate with them?
We were trying to make them a stronger customer of ours, and it's what they wanted. But the way we went to market was not the ideal situation for them. They wanted fewer and fewer trucks, fewer DSD delivery people. They wanted people going through their warehouse programs, trying to figure out the balance of evolving to that now. Walmart was a very small customer when I left, and they want it to be much larger. But the evolution of that was done really after I left because I wanted to do it a little bit quicker. And eventually the family took that into account and has done that. Walmart is one of our largest, if not our largest customer now, but they were tiny when I left. But the goal was to help evolve how we went to market from Walmart to meet them, right? Walmart is the biggest food retailer in the country, make them our largest client, commensurate with their percentage of the grocery market.
Were they very demanding as a customer?
Look, I think all the customers are demanding, but I think they were equally as demanding as others. They just had different points of view as to how they wanted their vendors to come to market. But I wouldn't say they were unreasonable. They just had different point of view and wanted to do it a little bit differently.
Ultimately, there was differences of opinions about the direction forward within the family. How did you folks deal with that situation?
I would say not well. It ended up in a family battle, and my father and I left in 2004 over that difference in. So my uncle passed away in 2000 in the early 2000s, in 2001, and that kind of started the rift getting bigger because obviously my uncle and my father had a very strong relationship. And then in 2004 it came to a head, and my father and I left the day-to-day over the decision whether it should all be family management or how we're going to move the business forward. And that's really what happened. Obviously, my father had much greater success than me. My father took the business over. We were doing $10 or $20 million in sales, eventually grew it to $1 billion enterprise. But the other two family branches wanted to go in a different direction, ended up in a big family squabble. My father and I left. Eventually, we healed all those issues and everything got back to normal in 2008 or so. And my father went back on the board, and eventually I took his position on the board a few years later as my father started aging out.
So you folks wanted to professionalize the business more?
Wanted to professionalize the business, evolve how we went to market, work with some of the bigger customers, clients, talk about more accelerated ways of going national, bringing in a professional board of directors, which had non-family, probably start with non-control outside members, 1, 2, 3, probably 2 or 3. I never felt it was good to have one outside member, but have at least 2 outside members and start setting it up so where the family could run this business and own it in perpetuity through governance. And whether the next generation or future generations wanted to be in management or not, the family could still control the destiny of this business and put its imprint on the culture and make sure that there was rules and regulations about how people came into the business. My feeling was we should have been talking to family business consultants and helping us through that process. We tried to go down that road, didn't work a couple of times. We hired and fired certain consultants, and the family just wasn't ready. And so it was better for us to take our leave and let the other 2/3 of the family run it. But yeah, my vision was to set this up for a perpetual hold and take out a lot of the drama of the family's dynamic and have it much more harmoniously through a professional structure where the family really controlled ownership and the board and decided who would be managing the business, whether that was family or not. But you needed to start that professionalization, was my feeling, to get to the next level.
Looking back, not specifically at that case, and I'm sure you've worked with a lot of family businesses since, is there a good way to handle that process?
Yeah, I think there is, but the family has to be ready. And my family just wasn't ready. And look, the business continues to do well. There's still some dysfunction, like in most family businesses, but hopefully we'll be able to get through all that and continue this being a family business.
What were the family discussions like around starting a family office and what its purpose should be after that?
I sat down with my father and he told him that, look, I think we need to be more organized about how we manage our liquid net worth and our trusts and estates. We had a very complex estate planning system. I had lost a brother by that point and lost my sister 4 years after that, one of my sisters. But my father and I sat down and discussed that we should start organizing ourselves and perpetuating the wealth of the family through one organization. And I took the lead on that and started the family office. Not everybody joined, but started really running my wealth, my parents' wealth, and my brother who had passed away, and then some of my sisters as well. And then eventually all my nieces and nephews I have 7 nieces and nephews from the 2 siblings that I lost. And then I have 9 other nieces and nephews. But it was just a vision to make things a little bit easier. We had started feeling that big banks were not really respecting families and high net worth individuals properly. They didn't really have open architecture at that point. We're talking 2004 or so. So if you were at Citi, Goldman, Bessemer, Wilmington, Chase, whoever, it was all about their product and selling product. And there was no real open architecture to get to alternatives and look at different types of investment product. It was all proprietary, and it was really a relationship manager and a sales pitch versus truly aligning with the family and seeing what their needs were and figuring out the best way for these managers to align with the family and help them create and perpetuate wealth. I think that has evolved now, but I think there has been a huge boom in family-run single-family offices since that early 2000 time till today. And my personal view is that was created because these big banks and asset managers didn't take care of their clients properly, and people decided we're smart enough, we can do it on our own. And I think it has also spawned some of these huge multifamily offices that 5 years ago were managing 300, 400, $1 billion are now managing 80 billion, 100 billion, 130 billion dollars. All of those, in my view, could have been kept by the large banks if they did a better job taking care of their high net worth individuals and families.
What were your initial experiences like doing private investments? What were the challenges of adding that to the overall strategy of the family office?
Deal flow was tough. It became very clear that a lot of the deals we were seeing were passed up by a bunch of other people. We were able to find some deals that worked and were good for us through our relationships and things of that nature. But it's hard unless your family office is really skilled and you have people who have been working in M&A and have deal flow or the ability to find deal flow. It's hard to create a M&A structure through a family office unless you're extremely sophisticated and big. But luckily, we got some good deals done at the family office that were on the smaller side that worked out well. We got our beak wet and understanding that we do want to be more in alternatives, not just liquids. And while we had an enormous amount of our wealth tied up in the family business, we still believed in longer term holds and alternatives and wanted to find a way to do more in alternatives. So we started building out that team. And then at some point, I decided that I wanted to start a private equity firm. I had institutionalized and professionalized the family office. It was running on its own, needed much less input from me.
How many people?
So it was about four or five people at that point. Still relatively small, but we had the right people in the right place. We had compliance and back office. Some of that was outsourced, but there was 4 or 5, I believe, at this point, 4 or 5 professionals.
And when you say alternatives, it was hedge funds, VC, private equity?
Yeah, running a manager's platform, looking at early stage, angel, VC, private deals, and things of that nature. So look, take a step back. My brother passed away in 1998. I left the family business in 1998, and I was going to start a private equity firm with some people I had been doing a bunch of research and work with. So a guy named Tim Havershon and Mike McGran, who were running the Family Business Center at Wharton, had done a ton of continuing education at Wharton's Family Business Center. And we were going to start a private investing platform, investing in being generalists with family businesses and using that bench of people that were clients of Wharton's Family Business Center as people we could rely on to help get deal flow. And also, if they were transitioning out of their business, putting them on boards and keeping them active. But I got called back to the family business in 1998 when my brother passed away after he was being groomed to take over the family business. I obviously didn't do that in 98, and I was COO from 98 to 04 of Goya. So when we left in 04, decided the first topic should have been building out the family office. And when the family office was built out, I looked back at what I had almost done in 98 in 2009 and realized this time, instead of just being a family business generalist, I wanted to look at more just consumer packaged goods, food and beverage, and pet businesses. And that's when I went on the search and met my current partners and launched the private equity firm. But that was really the evolution. We did some small deals. The family office realized I needed a much bigger team, dedicated team, if we wanted to do real private equity investing. And that's what I ventured out to do. Started AUA Private Equity and left the family office to be run by itself. There's some oversight, obviously, from the family. My father was still alive at the time, so he was spending some time at the family office. But my day-to-day work really left the family office in that 2009, 2010 timeframe, and focused on finding the right team and building out a private equity platform. And that's when I met my current partners, Kais, Dave, and Steve.
What do you think family offices get wrong about private investing?
Thinking that it's easy and that a lot of times you've had success in one or two businesses of your own. I think deal flow is hard to come by unless you build out a team. We've dealt with tons of our investors or family offices who have tried to do it on their own and realized that they're not getting the returns they want, and even paying traditional private equity fees, you're still going to outperform if you pick the right managers. And that's how we've gotten some of our investors into the fund. But, and look, there's lots of things that get right and lots of things that go wrong in any process. But again, a lot of times people are starting these family offices after they've had big liquidity events, and sometimes motivations change when you walk away with serious cash, and it's not necessary for you, your kids, your grandkids to go and grind it out. Sometimes that changes the dynamic on how people work.
So you met the right partners. How did you initially get the firm off the ground?
First of all, I talked to a bunch of people, that 15 to 20 groups or individuals, either at private equity shops or out of M&A departments from large CPG companies. And yeah, I found my current partners, started talking to them, started spending more and more time with them, started looking at deals with them, checking out what their deal flow was like. And then at some point told them that we were basically running an informal partnership. We should formalize the partnership, that I would carry the salaries for the first year or two until we got this off the ground. And that's what we did. I subsidized the company for a year or two. I don't remember how much, paid everybody's salaries, got the business running, started doing deals. And then we raised a fund around one of the deals we were looking at and launched the firm. And eventually, when we raised enough capital, the subsidies from me ended and the business became self-funding, and it's been a great partnership. Like I said, the firm has grown. So there was 4 partners to start: me, Kais, Dave, and Steve. We're now 13 people strong, still run a lean team, but there's 4 partners, 4 vice presidents who will eventually become principals and eventually partner. And we prefer to build from the ground and have them grow up in the firm. So we add 1 or 2 associates a year, and hopefully they progress through. Some are just 2-year programs. There are 2-year associate when they cycle out, but some we keep through, and hopefully we'll grow with the team.
How did you get your first institutional investment?
Through this first deal, we found this deal that we thought would be a great deal. I was Associated Foods, worked with Harry and Ira, who were the 2 patriarchs from 2 different families who had been running the business for decades. And they each had a couple of children in the business, but wanted to transition and eventually have a full sale. So we helped them do that. It was a great deal, great gentleman that we worked with. Harry was in his 80s when we did the deal, Ira in his 70s. Harry has since passed away, but he was a great guy, learned a ton from him. And Ira is still around and kicking, has since moved to Florida, still talk to him often. But 2 great guys who built an amazing business. But we locked that deal up. We warehoused it. So the family backstopped it, closed the deal, and then we raised the fund around that deal. So we brought it to some significant families who I would call institutional, and to some institutions who looked at the deal, and we started. That first fund was a small fund, $152 million, but larger than what we expected that we were going to raise in the first fund. I think we wanted to raise $85 million in the first fund, but ended up raising 152. A lot of that was due to the associated deal, and we offered some co-invest in that deal. So I don't remember the exact numbers, but we put $20 or $30 million from the fund and $20 or $40 million of co-invest in the deal. So it helped us get institutional investors. So that first fund was about half institutional, was about half family offices. And then the GP, me and my partners, my family, were a big investor. We prefer to be somewhere between 15 and 20% of each of the funds we launch. So we were a big commitment to that fund that helped institutions get comfortable with us. And like I said, that first deal. So we had a Honeywell's corporate pension. We had a few fund of funds, institutional families, Illinois Municipal Retirement Fund. We had some public pensions, corporate pensions, and large family offices and small family offices too. So we also wanted to open up the fund to smaller investors so that people who were writing $1 million checks into funds or deals had access to alternatives in private equity as well.
Associated Food, what was attractive about that deal? How did you find it?
We found it a couple of ways. We had announced our partnership. The owners had heard about us. And one of the owners that actually was a member of the same temple as one of my partners, Steve. I just started talking to him, and we all sat down and talked about what a transaction would look like. It was in the tri-state area of New York where I cut my teeth at Goya and grown up. It was a powerful business. It was big cash flowing business. It just great cash flow, asset light, had strong customers. So it was Associated Foods is basically a independent co-op. So all the stores within the system, so Associated, Compare, Met Foods, Pioneer Foods, were owned by individuals, or an individual or a family owned a group of stores. But we handled the whole distribution channel, the marketing, the sales, promotion schedule for between them and all the big vendors. And it'd been in business a long time. Harry and I were great people, respectful, trustworthy, had a good reputation. The supermarket industry in the tri-state area had evolved and was primarily owned by Latinos, Dominicans primarily at this point. So there was a cultural tie to it. I had spent 3+ years living in the Dominican Republic when I was at Goya before I had left and came back, and it was in the food industry. So it just checked off a lot of boxes. We wanted to invest in family businesses. We wanted to invest in food businesses. We wanted cultural relevance where we could actually help these families transition while keeping their cultural stamp on the business and helping them foment that family culture, institutionalize it while keeping all that in play, building a stronger, more fortified business so that culture could go on when we sold the business. Knew some people in the industry that we thought could help us from a management team perspective. There was a big distributor at the time called White Rose. They eventually went bankrupt, but they were our primary distributor. We eventually transitioned to C&S, which is another family business, very well run, great family business, huge. But Rick Cohen was a great partner when we moved from White Rose to C&S. But I'd known the White Rose people for a long time. So we built out a great, strong management team that we knew we could bring along. And then eventually, 5 years later, orchestrated a management buyout where that team that we bought in actually ended up buying the business from us and is still currently running the business. And people I've known for decades and are now creating great family wealth for themselves. So it's the only management buyout that we've ever orchestrated, but it's worked out. It's worked out well.
How do you think about assessing these management teams?
People often ask me, what's your job? And basically, I tell them I'm a human resource director at the end of the day. I assess good management teams and determine where the strengths and weaknesses are and supplement those for family businesses and help sometimes in transitioning family management out or senior management out with similar quality or better, hopefully, management teams. So that's the majority of what we do in hopefully a respectful and thoughtful manner so that culture of the family stays intact, but that we can extract some more value out of these businesses. But we're not distressed players. We are buying very well-run family businesses that want at some point a full transition out of their usually largest asset. And we've been very successful in that. And look, not everything goes perfectly. Sometimes we think that a matriarch or patriarch can be the CEO throughout the entire hold. And sometimes we get that wrong. We got to transition out. Sometimes we think that they won't be able to grow with the business, and we have a 2 or 3 year transition period built into the plan, and turns out they grow and accelerate the growth of these companies more than we anticipated. We keep them on. We've had two situations where that was a case where we thought we were going to need to transition the family CEOs out. And in two situations, we've sold the business and they've actually rolled on to the next owner and stayed as CEO. And it's worked out great for them and for us. And in one case, we sold the business for 5.5 times more than we paid, had tremendous growth. And that family rolled more equity into the next round than their business was worth when we partnered with them. And so they're very happy. And Peter is still the CEO there and doing a great job. And a similar situation with the other deal, family institutional dessert business. We made 3 times our money, and an Italian strategic dessert business wanted a foothold in the United States, and they bought our business and asked John to stay on as the president of the United States for them. And it's worked out extremely well as well. And I will say all those times that we've sold a business, except for Associated because of the age of the patriarchs, Harry lived a couple of years after we sold and he was in his mid 80s by that point, and Ira was approaching 80. But every family that we've sold the business has become an investor in the subsequent fund. I think that's one of the things I'm most proud about, is that they saw what we did for their family, believed in the model, and want to help and invest in this model going forward.
What can you tell us about True Food? What is the company and who was the owner when you found it?
The Sudas family. So this was one of the more unique deals for us. This was a good business with a bad balance sheet. Like I said, we are not distressed players, but we thought this was a good business. And the Sudas family had built a very strong business in the co-manufacturing and private label manufacturing space in protein bars and granola. They had gotten in too deep with one client, one customer, ended up becoming about 70% of their business. And as they started building infrastructure around the growth of that business, the family, their customer, started backing out and eventually pulled a bunch of their business away, putting the family in a bad place with their bank. They started leaning on their vendors and delaying payment, but ended up, we got a call from the lender, from the bank, telling us that this is a good business, they just have an impaired balance sheet, and would we help them out? So we took a look at the business. Unfortunately, the balance sheet was more impaired than we were willing to deal with. We told the bank that the balance sheet was too impaired. The bank ended up, through an Article 9 transaction, taking possession of all the assets of the business and approached us about buying the assets and restarting a new business with all the assets and the machinery and things of that nature. And if we had acted quick enough, we could probably retain 2,000 jobs and save 2,000 jobs. Spoke to the bank, told them we would do that. So we bought all the assets from the bank, reconstituted a new business, actually then went to the Sudas family, Pete, who was a great guy, talked to him about if he would be willing to be helpful and come back. He was on the hook through personal guarantees for some of this debt. His family was in a little bit of a stressed position, but he's a very good salesman and ran a good business, just got out over his skis. We spoke to some people that we knew, who we brought in to help us transition the business. Pete came back in and we gave him some options and some ability to make some real money back if things went well. We partnered with the bank. They lent us some money. We put in some capital, put in a lot of capital, ended up really straightening out the business, fixing the balance sheet, building new sales channels, cleaning up some sales contracts, changed how we ran the business, cleaned up manufacturing, made the manufacturing much more efficient and leaner, and took a business that was basically break even, making a couple of $1 million of EBITDA to over $30 million of EBITDA in 3.5 years, and sold that business. And Pete went from being in a very tough situation to creating generational wealth again through the exit of that. So Kites was the deal lead on that, did a great job and really made an imprint on Pete, his family. And Pete is now an investor with us and helps us in some other companies as well. Great family. We grew the business, built a big R&D team, got into molded chocolates and confectionery, started working with our customers on new product. We helped launch some new products for some of our clients in areas they weren't in. And we sold the business to a large sovereign wealth fund called Mubadala, and they're doing extremely well. They've done a few tuck-in acquisitions, but really built a platform for a larger player like Mubadala to really take it to the next step.
How do you think about synergies across the companies in your various portfolios?
Sometimes it'd be great if everything was synergistic and we could bind together and buy sugar together, or cow or flour. But really, it's a little bit harder than it looks. But all the CEOs get together once a quarter or once or 3 times a year or so, talk about ideas, what they're seeing in their businesses. If there is ways we can synergize, there are some things that we can synergize that aren't really that impactful, but helpful. Healthcare sometimes, or insurance, things that are often done at the fund level. But we do talk about ideas and see what price we're buying things at, and if we can help on raw material purchases. All the portfolio companies help each other out. But we have not seen tremendous success in being able to say, hey, look, you're buying flour, we're buying flour. There's 3 portfolio companies buying flour. Let's force our vendors into a bigger contract. And part of the reason is, at least for us, is as you sell companies, those contracts and that purchasing power kind of dissipates. Because if you had 3 portfolios company who were buying and then you sell 2 of the companies, now your cost structure gets out of whack with the remaining companies. So we want to make sure all these companies can be run independently and sourced independently without those broader contracts.
These are such great stories. Could you tell us about Water Lilies?
Yeah, Water Lilies was a great deal. This was one of the businesses where the family retained a large portion of the business. It's a co-manufacturer and private label manufacturer of Asian appetizers, frozen appetizers, and some entrees. And they had a great customer base, P.F. Chang's on the restaurant side, but also all these high-end Wegmans, so great supermarkets, Trader Joe's. So we were making their egg rolls, spring rolls, pot stickers, dumplings, bao buns, things of that nature. The family emigrated from Taiwan. Second generation was taking over. Peter and his wife, Lucia, did a phenomenal job. This was one where we felt as we grew the business, Peter may have needed more support, but he ends up being a phenomenal CEO. And him and his wife and the team did a great job. We installed a new CFO, built out a board, and really grew this business tremendously, got into new channels, made the plant more efficient. They were in the middle of they were undertaking whether or not to move and build a new facility. And that's really how we connected with them. We had been talking to them. Dave was the deal lead on this one. And David built a very good relationship with Peter and Lucia and done a great job getting to know them, speaking to them for years, but they were never ready. And then they needed to move, and it was a big capital expenditure. Peter's parents were less eager to deploy capital back into the business. And that's when they reached out to us on a more serious level. We talked, struck a great deal, helped in the transition and the move and the expansion of the facility. We're able to, through busing in the beginning, retain all the employees, which is important to us too, keeping that culture, and had a great deal, built that business up, grew sales by, I think, 4 or 5-fold, EBITDA by 3 times, and sold that business for 5.5 times what we invested, but built out a stronger sales channel, increased the efficiency in the plant, increased the product diversity, and all very good product, high quality, and it was a great transaction. And Peter actually sat on a panel for us at our annual investor conference last year and just talked about his working with AUA, and he said something in there that we often quote, because as families look to partner with us, they understand that we are going to have control of the business, but we want them to be as important and learn from them as much as possible. So one of the things Peter said in this interview on the panel was, I knew I was giving up control to Andy and AUA, but never felt control. And that's what we try to do. These families that we're partnering with, they're extremely important to us. And that's why we require them to roll significant equity into the new deal, because we need to learn a ton from them. And we do. And like I said, this was a deal where we thought we were going to kind of transition Peter into a CEO or president role and have a CEO or president really run the day-to-day of the business. But Peter was amazing and really grew into the role and ran a phenomenal business. Still does. He rolled in, we sold to another private equity firm, and he is still president and CEO of the business and still growing tremendously. We sold a little bit early, so we sold in about 4 years, but had a great return. Like I said, 5.5 times. But we were at an inflection point where the demand was much more than our ability to supply. So there was an inflection point where we would need to hold this business for another 2 or 3 years if we didn't sell now, because a big CapEx project would need to go into the ground and we'd need to put shovels in the ground to re-expand or open up a second facility. And whether we wanted to put $30 million of new equity in to build a facility and create all the infrastructure around that or sell, we decided to test the waters, and we thought we'd get X dollars. We ended up getting 2 times what we thought the market would pay. And it's still been a great deal for the new owner. And I think he misses us, but that might just be my bias. But I think he's happy with his new partners and they're doing extremely well. So look, that's important to us too, is when we sell a business, we want to make sure there's plenty of runway for the next owner to make money and have a successful transaction. And this has been a great business. It was a great hold for us. Peter's still a friend of the firm. Like I said, he's an investor as well, and couldn't be happier for him and his family.
How do you think about risk across the portfolios?
Hopefully we're buying stable family businesses. We're not taking huge risk on some of the newer brands. Now, we will manufacture for some of those brands through the co-man cycle, but we try and, through portfolio construction, balance out businesses that we think will be low 20s net return to our investors to high 20s. And if we can get high 20s with a little bit of more risk, but still have clarity that we think we can get that, we'll take it. And we will underwrite to a lower return of 20, 21% if it's a much more stable business, slower growth, and hopefully we can unlock some other things where we can maybe boost that return, even though it has lower risk. And there's a business called Weaver that we partnered with a 5th or 6th generation family popcorn business called Weaver Popcorn. And this was a CPI growth business, 2-3% a year. We underwrote that to lower returns, but extremely stable, huge cash flow. And so that we underwrote to low 20s return. Fortunately, we've been able to unlock some efficiencies in the manufacturing, and I've looked at some other higher growth alternatives. So we've been able to grow that business. In the first year, we grew from about, I want to say, low 20s of EBITDA to high 20s of EBITDA. We were able to refinance the business in less than a year and return 60% of investors' capital in less than a year in that business, and still keep the debt ratio the same. And that business continues to perform. But that was one where we underwrote, because of the stability and the lack of, and the strong downside protection, we underwrote to a low 20s return, but it is now trending in the 30s and 40s where we think we'll exit. It's been a great business, but that we've done that through the middle of the balance sheet and some stronger growth top line than we expected. And we have some RFPs out with some large chains now to do their private label. So hopefully that business will outperform what we underwrote to. But that's usually how we view risk, trying to manage between low 20s return and low 30s return net to our investors, depending on the risk profile.
How has your involvement with Babson and Wharton's programs advanced your thinking?
One of the gentlemen that I almost launched the firm with in 1998, Tim Habershon, who ran the Family Business Center at Wharton, actually moved and opened the Family Entrepreneurship Center at Babson. So I'd done continuing classes there. Tim stayed a friend and mentor to me in many ways. He's actually one of our operating or value creation partners, helps me come up with strategies and sits with the families and talks to them about the AUA differentiators and what we're different about them. I will go up and teach a class every once in a while at Babson for family businesses and guest lecture for Tim, who is still a professor there. Tim is now in-house and works with the Johnson family at Fidelity and runs all their family business programming and things of that nature at Fidelity. But he's a tremendous resource to us and gives us access to that Babson kind of culture and staying in touch with families and entrepreneurial spirit. And I love family business. So if I can get in front of 15 to 30 kids who are either interested in working with family businesses or are part of the family business, it's always helpful and insightful to me, to keeps me what may be called the cutting edge of how families are seeing. And being at Babson, there's a lot of Central and South American families involved there too. So seeing the cultural differences between Central, South American, and U.S. families and how they run is exciting to me.
What are some of the cultural differences?
I think you don't see many families in the United States dominating an entire country's wealth channel. So you look at some of these third, fourth, fifth generation families in Central South America who are extremely powerful. I'm not saying that families here aren't powerful, but just the amount of the GDP that they generate for their countries is stronger than in this country. The ability to have extreme success in one channel or one sector, and because of the wealth you're creating, be able to open up another totally different business and be successful there, I think is different. And I think the view that you want, and there may be, and this is just my view, there is a little more pressure to go into the family business, I think, in those cultures than here in the United States. But ubiquitous, whether it's United States, Europe, Central America, South America, Asia, education is paramount. They all understand. And I think you see it even stronger in some of these Central and South American countries, especially people of Cuban descent or people who have been thrown out or have left their country with nothing after creating extreme wealth, understanding that education is something that people can't take away from you. Even if there is some sort of government or political disruption, you will be able to be successful in your next country. And I think that's one real things about America, whereas the success of the Cuban population and even the Venezuelan population now, and people who have left some of these countries have had extreme success here because of that strength that they've seen and the education they've gotten, not just in their family business, but through schooling, I think is important.
Andy, thank you for joining us and sharing your wonderful insights.
My pleasure, Joe. Always good to see you, and thank you for taking the time.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.